you basically have two major things, right? So in any case, it's not just audit. In any case, right, you have a plan and you have a strategy to achieve that plan, correct? Now, why plan audit? Why do you need to plan audit? So there are certain points that you need to remember, and this might come in the exam as well, right? So you need to remember these. Number one, it is required by ISO 300. That's the basic, right? Engagement objectives are achieved in an effective and efficient manner. What are the engagement objectives? To form an opinion on the financial statements, right? Important areas are targeted with appropriate resources. Important means risky because we perform a risk-based audit, right? Helps to identify and resolve important issues during the engagement. Okay, so obviously you can easily target, identify, and resolve important risky areas. Okay, suitable and competent team members with adequate amount of experience are taken on board. Obviously, if you plan the audit, right, if you give sufficient time to the planning part, right, you can easily highlight what type of resources you need for the engagement, right? Obviously, for an engagement of for an audit of a bank, let's say, you will not take on board people who are experienced in the manufacturing sector, or let's say not-for-profit organizations, right? You will only take people on board who are experienced in the financial sector. Okay, assist audit to manage the engagement effectively and coordinate work of others, such as internal audit and subject experts. Obviously, you have to uh, assess. Obviously, the point is that when you're auditing, right, like I told you guys earlier, just 3 months, right? You guys have just maximum 3 to 4 months to audit a particular company, right? You would obviously use, and you can use experts or internal audit to perform certain tasks, or tasks they've already performed. You can use their work to place reliance on a certain, let's say, element, right? But the point is, you have to assess their effectiveness, their independence, and the work they've performed. How effective were the procedures, and how effective was the evidence that they've gathered by performing those procedures. All right. Helps senior audit to assess and review the work of their team members effectively and on a timely basis. Obviously, if you have certain deadlines, certain timelines within aligned within your team, right, you can easily, or the senior can easily, you know, uh, target or test or assess each person's work individually, right? So, for example, if I audit, let's say, the property, plant, and equipment area, right? If that is a major area, and if during planning you've already assessed that it will take time, right, and it's a risky area, obviously the audit senior will also allot me the required time, okay, for review. In all, planning of audit procedures or audit reduces the audit risk to an acceptably low level, right? So even this is what ISO 300 tells you, that you need to plan an audit of financial statements. Why? Majorly because your audit risk is reduced to an acceptable level. All right. Give me a second. Now, the point is how to plan an audit, right? Why do you need to plan audit? You already studied that. How to plan audit. So there are two things, right? The first and the initial part is perform acceptance and continuous procedures that we've already studied earlier, right? Develop audit strategy and develop an audit plan. Okay, what is the audit strategy? How do you strategize an audit? So strategy is basically the major, basically achieving your objectives, right? Ultimate objective, which is what? Forming an opinion on the financial statements, correct? Now, in order to form an opinion on the financial statements, you need an understanding of the environment and the controls of an entity, correct? Not just the control environment, but the business environment as well, the economic environment as well, right? So you perform initial procedures for understanding of entity and its environment, we studied in the last uh, lecture, right? Selection, allocation of team members, you need that. Reporting and communication channels with client, experts, and within team. How will you communicate your work to your senior? How will you send them the sheets? How will you send them your working papers? How will you report to your partner when you were basically presenting evidence that you've gathered? How will you communicate with the client? Will it be a direct communication? Will it be through the client, right? Sorry, how will you communicate with third party? For third party confirmations, for example, you want to, let's say, communicate with the bank, right? You want to confirm the bank balance of your client, right? How will you communicate with them? How will you communicate with the bank? Will you send a direct confirmation, or will it be via the client, right? So you have to set communication and reporting channels. Okay, how will you communicate with an expert? For example, let's say you guys have studied IS 40 property investment property, right? If you want to perform a fair valuation of investment property, obviously you need an expert to do that, right? How will you communicate with that expert? Will that expert send you its report via client, or will it send you directly, right? So all of these things need to be predetermined before you start the audit. Okay, engagement deadline timings, very, very, very important. A lot of issues arise around this area. You need to be clear about the deadline and the timings. Okay, if I tell you, if it's obviously, these are things mentioned in the engagement letter as well, right? If you remember the elements of engagement letter, this is one of the major things that is mentioned over there. Okay, assessment of need of experts and reliance on the work of service organizations. Okay, so obviously I will explain later what service organizations are, right? But you need to assess whether their work is reliable and to what extent their work impacts the financial statement. Obviously, since we're forming opinion on the financial statements, everything should be linked to the impact on financial statements, correct? Dates by which the resources should be deployed, very important. I remember this happened um, with one of our clients when I started out in PwC, right? We had a review engagement halfway through the year, but obviously, since the client didn't want us to come early than the required date, because they wanted us to finish audit by a deadline, right? So it was, I remember it was a deadline of, let's say, 25 days from the start. And the 25th day was the end of Feb. So it was 28th Feb. They wanted us to finish the engagement. So they wouldn't let us within, because obviously our director was arguing with them that can you please let them beforehand, before, let's say they wanted us to be there by 20th Jan, but they weren't allowing us because obviously they had their own reasons. They were saying that the accounts weren't prepared, the financing wasn't ready, and all of these things, right? They make all of the client makes all kinds of excuses. Okay, it's not possible for them to have their basic accounting records ready because it's for the entire year, right? We could have assessed for the first few months, not for the last 2 or 3 months. We would have assessed the vouchers, let's say, for the first 3 months, but they wouldn't allow us. Okay, so they basically let us enter the premises on, I remember it was 5th Feb, right? And that's when, no, not 5th Feb, basically 3rd Feb. Yes. So that's when they allowed us to enter the premises, right? And before that, because obviously we were free for, let's say, 15 days, 2 weeks, and we had to do other clients because of that. Okay. That was just something that wasn't planned. So these things happen. Materiality and performance. Materiality, obviously, like I told you guys, overall materiality and your performance materiality needs to be assessed or calculated during the time you're making your audit strategy. So yeah, all right. So the point is, it sets the overall approach, which I've mentioned over here, that is scope, timing, and direction of audit. All right. What does the audit plan do? So strategy is the bigger part. What does an audit plan do? Right? Planning of an audit involves two things: making an audit strategy and making an audit plan. Okay. So don't confuse these two things. Planning involves these two things. These are two separate documents. Okay. Audit plan sets the operational details of how the strategy shall be achieved. Okay, how will you achieve the strategy? How will you achieve the targets set in the strategy that will obviously help you achieve the ultimate objective? Okay, so nature, timing, and extent of risk assessment procedures is one thing, and nature, timing, extent of further audit procedures is another thing, right? Risk assessment procedures we already discussed in the risk assessment chapter, right? Nature, timing, and extent of further audit procedures. Obviously, if you've assessed risk, if you've performed, you remember that an auditor performs procedures in order to assess risk, right? And if you find significant risks, right? If the risk profile of the entity is high, right? That means you place less reliance on the control environment. You place less reliance on the controls. You place less reliance on the test of controls, and you increase the number of substantive procedures, which are also called for now procedures, right? So, for example, a test of control could be that, you know, let's say a bank reconciliation. You all know what a bank reconciliation and why is it made, right? Now the point is, let's say, or forget bank reconciliation. Let's say um, let's talk about the supply chain. All right. So a procurement manager, if it wants to procure anything above $50,000, right? It creates a purchase requisition, right? And it is sent, so the production department creates a purchase requisition, sent to the procurement department. Procurement department gets it approved not only by its HOD, not only by the procurement head, but by the CFO and CEO as well. Okay, so this is a control, for example, okay, by the CFO and the CEO as well. All right. Now the point is, for example, you've come across a fraud during the current year, which happened as a result of this, and there was inventory that was being stolen, right? What do? You assess. Obviously, your assessment would be what? That the risk over here is high, right? And you will not place your reliance on the signatures of the CEO and the CFO and the procurement head, right? You would rather perform your substantive procedures, which could be, let's say, a reconciliation of the inventory, just to make sure that no fraud has taken place after, let's say, the initial fraud, which was initially discovered. All right. So obviously, test of controls is what? There are certain controls. Obviously, you have a chapter for it, right? And we'll study it in detail. But the point is, you just need to know the brief element of it. So, for example, the company that has set controls over a purchase of, let's say, $50,000, what is that? It needs to be approved by the HOD, by the CFO, and by the CEO. That's a control. All right. So that, the purchase is not irrelevant. It's not excessive. It's not something that, it is basically questioned by the most top authority within the organization. Okay. So it doesn't go unchecked. Get it? But the point is, since there was a fraud, someone, let's say, copied the signature of the CEO or the CFO, right? Which resulted in a fraud, and obviously the procurement came in, and the stock was stolen, right? It was stolen right outside the company from the warehouse, right? There are a lot of cases. These cases happen. I'm not just making it up. These things happen, especially, let's say, I've seen this in beverage companies. Okay, so I won't name a company, but beverage companies, it's very easy to steal, let's say a crate or two from the entire stock, or let's say 5 crates, 10 crates, even 20 crates, they go missing. Okay, so the point is these things happen. All right, but the point is that controls, now you test them. How do you test them? You check whether they're effective or not, right? So let's say you come across a purchase requisition that has not been approved by the CFO, but is been approved by the HOD and the CEO, and it's, let's say, a $80,000 purchase requisition, Do you think the controls are working effectively? No, because there needs to be the sign of three people: procurement, so that you know the HOD of the procurement department knows exactly why is it being purchased and whether it's actually a requirement or not. The CFO, so that he knows, obviously it's the head of the finance department, he knows how much funds are being utilized in this consignment and at what time will they be utilized. So let's say if it's a cash purchase, you have to issue a check there and then, right? But if let's say it's a credit purchase, how much credit time do we have? Okay, and finally the CEO, so that purchase of larger amount or significant purchases, so let's say noticeable purchases, the CEO should know about it, right? He's the head, he's the one running the show. All right. So the point is, if for example on a procurement document or a purchase requisition of $80,000 you have signatures of CEO and the HOD but not of CFO, that means the controls are not effective. So you will place, that means and it makes it more risky. If the controls are not in place, or the controls are in place but they're not effective, right? That means it's risky, right? So you perform more audit procedures, which include, let's say, reconciliation or, you know, inventory count. You can do that as well. Okay. So for example, in inventory count, what do we do? I'm just giving you examples so that you understand exactly what is done, right? So what do you do in inventory count? You take a piece of paper which has all the inventory listed on it, right? And you perform an inventory count how? Floor to sheet and sheet to floor. What is floor to sheet? You look at the number of items on the floor, that means physically present in the warehouse, and you confirm each and every item against the sheet you have. That is one way of doing it, right? So anything that is physically present on the floor but is not on the sheet, that means your records are not up to point, right? And there's sheet to floor. That means anything that is on the sheet should be there on the floor. If it's not, then obviously it could be, due to you've removed it due to obsolescence, or you've removed it due to, let's say, or it's been stolen, you've removed it because it's been sold, right? So there could be various reasons. You obviously investigate the reason. You basically gather evidence around the reason. Why? Because obviously you need to make sure that your records are up to point. If it's been sold before year end, you remove it from the sheet. Why hasn't it been removed? It means your records are not up to date. All right. So these are various ways to assess the risk and to further respond to the risk. So these are all responses to the risk that I told you. Okay. Now, nature, timing, and extent. These three, remember these three things, right? So for strategy, it was what? Scope, timing, and direction, because it's at a macro level, right? But when we look at a micro level, at a much detailed level, right? You need the nature. What exactly is the procedure that you're performing? The timing, when do you perform it? For example, if you perform inventory counts at, let's say, 28th December 2020, do you think it will be relevant? Do you think the figure will be relevant? No. The only figure that will be relevant is of 31st December 2020, because inventory is as at. All right, as at means as at 31st December 2020, right? Anything that goes to the balance sheet is as at. Okay, so if you're confirming the inventory before 31st December, means that you're not getting the right figure. Yes, this happens a lot where there's fast moving consumer goods. For example, let's take an example for the beverages. What we used to do was that we used to perform reconciliations. Okay, inventory count, let's say whenever there's a holiday, let's say a holiday for the production, nearest holiday for the production, so let's say 28th December is the nearest holiday for the production. That means there's no incoming or outgoing inventory at that date, right? So what we used to do was we used to perform an inventory count at that time and then perform a reconciliation. So for for 29th, 30th, and 31st, right? For the rest of the 3 days, whatever sales happened, right, or whatever leakages were there, or whatever breakages were there, we used to remove it from the inventory, right? And then it's not just, you don't stop at this point. What you do is you confirm it with the sale after the year end as well. Make sure you get to the right point. So it's backward confirmation and forward confirmation, right? Forward is what? You start from 28th, you perform a count on 28th, and you reconcile it to 31st. And the backward confirmation is what? You start from, let's say, 5th January 2021, and you perform a reconciliation back to 31st December. You should get the same figure. Okay? Get it? Are you guys getting all this stuff, or is it all Chinese for you?
No, sir, I understand it.
Divya, Harsha?
Sir, understand.
Understand.
All right, great. Now, nature, timing, and extent. So we're talking about timing. Extent. How extensive should a procedure be? Let's say I perform inventory count, and from what I believe, in the past, there has been no discrepancy in the inventory figure. That means I can place reliance on just one inventory count and don't need to perform it again and again, or I don't need to create a reconciliation for the inventories, or let's say I don't need to look into further details for inventories, right? So, again, extent depends on the risk itself, right? What audit procedures to perform based on risk assessment, how much work should be done, right? Who should perform the procedures? This is very important. Who should perform the procedures? All right. Someone, for example, if let's say I have an understanding of the inventory, for example, it's a chemical, right? Now, I haven't performed audit of, let's say, a chemical company before. Do you think I should be going to the inventory count? And I've escaped this way, like I've escaped a lot of inventory counts this way, right? They used to send me to, very large, huge inventory counts of MNCs, and I used to skip it. How? So I don't have relevant experience. Okay, and I liked easier inventory counts basically. Inventory count is the worst nightmare of an auditor. Okay, who should perform the procedures, or like when are the procedures to be performed? Like I told you guys. Okay, so what, how, who, and when. Okay. Strategy consists of the overall approach taken related to an engagement, whereas plan consists of the approach to target each area of the financial statements. So what does each area mean? In SOFP, you have different areas. In SOCI, you have different areas. Obviously, remember one thing. Something that has physical existence can be vouched. Something that is present there, point in time. All right. For example, asset. An asset is present there, point in time. But can you basically physically observe revenue? You cannot. It's a performance. It's a thing that you perform, right? So the point is that cannot be observed there and then because it was performed or it was accrued over the year, right? But yes, PPE, any additions, deletions, you can vouch it there and then, okay? At a particular point in time, let's say 31st December, 4 o'clock. You can look at PPE. You can look at licenses, which you classify it in intangible assets. You can look at, let's say, your inventories, okay, your stocks and spares, your spare parts, anything like that, okay. But what you can't look at is basically something that does not have physical existence or something that is accrued over the period, okay. So you have to perform different procedures for that. You cannot say observe revenue that was that was accrued during the year. It's not a valid procedure. How do you observe revenue? You cannot. Okay. Auditor must exercise professional judgment, professional skepticism throughout the engagement. Very, very, very important. All right. You must exercise professional judgment, professional skepticism. Okay. Now, interim versus final audit. What is an interim audit and final audit? Obviously, this is something that we already have studied for in the past. Interim audit takes place to reduce the burden of final audit. This is, and this happens with, large organizations that have a lot of data, a lot of transactions going on during the year, right? But it also increases the cost of the client. Obviously, we will not do it for free. Fine with auditors, but we won't do it for free. Okay. It does not mean that these two are separate engagements. Both engagements take place in the same financial statements. Remember this. Only one audit report shall be issued that will be after the final audit. Okay. So it's basically final audit bifurcated into two separate engagements. Okay. Extent of substantive procedures can be reduced in the final audit if the control risk is determined to be low at the interim audit and vice versa. So interim audit technically it's all about assessing the control environment of an organization, of the client. All right. Because if the control risk is high, obviously you perform greater procedures, more extensive procedures during the final audit. And you can easily, interim audit helps you a lot in planning of your final audit. Remember this, because obviously it's there's a good 4 month, 3 to 4 months, quarter, at least a quarter time difference between between you when you finish the interim audit and you start the final audit. Okay, so you have good 3 months to assess what will you do in the final audit. And obviously, like it's mentioned over here, it reduces the audit risk to a significant level. Okay. If substantive procedures are performed at the interim audit and sufficient appropriate audit evidence is obtained, the procedures at final audit can be reduced. Okay. Now, there's a bit, compare and contrast of interim and final audit. I'm giving you guys 5 minutes. I want you to read the points and come back to me if you don't, get any of the points. All right, 5 minutes. I want you to give a good read. A very important standard, ISA 250, about auditors' responsibilities related to laws and regulations. I've told you guys again and again that you don't need to remember it's good that you know the ISAs, right? But you don't need to, you don't have marks for putting it down in the exam. Okay. Management's responsibility related to laws and regulations, what is it? To ensure that the operations are conducted in accordance with the applicable laws and regulations. Not just the operations, everything. All right. All business transactions are conducted within the domains of laws and regulations. Let's say I get a tender for printing, let's say 1 million copies, for example, right? Now I'm producing those 1 million copies within the respective laws and regulations, but the way I obtained that tender, let's say through bribe, is something that I went beyond the fine line between legal and illegal. Okay, so that is not accepted. Auditor's responsibility is to perform procedures to identify any non-compliance with laws and regulations that have direct impact on the financial statements, tax law, regulatory non-compliance, applicable reporting framework. There's applicable reporting financial framework. Okay. Perform procedures to identify non-compliance with other laws and regulations that may have a material impact on FS, such as intellectual property law, data protection law, public health law, etc. Companies are usually, they're involved in manipulating, for example, in developing countries, a lot of companies, they are involved in child labor, right? They make huge stuff, like billions of dollars worth of inventories through child labor. And that's against the Labor Act or the Child Protection Labor Act, right? So the various acts, there are various laws that the government has, produced to protect child labor. Okay, and if a company, if you, for example, if you come across as an auditor that the inventory is being produced by, you know, children who are under the age, who are underage, basically, you can report it to the authorities, right? Provided you have consulted, you have basically discussed this matter with those charged with governance, okay, and they're not willing to correct it. Obviously, if they're paying the penalty, that is one thing, right? Gather sufficient appropriate audit evidence through the procedures performed to ensure financial statements are free from non-compliance. All right, because if, for example, you're into this stuff, obviously it will have an impact on the financial statement in the form of penalties. It has a financial impact, correct? And also, you guys know that there's a lot of emphasis being placed on integrated reporting these days, right? Sustainability reporting, green reporting. Okay, so this is against the ethics of doing business. Child labor is against ethics of doing business. It's against business ethics. Okay, so this might go as a disclosure in the reports. Obviously, you're not concerned with the integrated report itself because you're here to audit the financial statements. But yes, if you are performing the review of the integrated report, it is an obligation on you to get it disclosed. It needs to be disclosed. All right. Identify risk of non-compliance through obtaining thorough understanding of the regulatory framework that is applicable on the business and not only on the financial statements. Very important. You need to know which regulatory framework the business works in, right? Why do businesses go and, you know, incorporate their companies in Panama, or let's say Cayman Islands or British Virginia, right? Why do they do that? Because there are very less regulations over there, especially related to the finance coming in and going out. Inquiring board members and TCW, which is those charged with governance, about any non-compliances. Inspecting board minutes is the, like, is the best procedure to perform when you're basically, involved in high level when you're assessing high level transactions, basically. Okay, or you're assessing high level events. So in inspecting board minutes to assess any discussion on non-compliance, inspecting correspondence of clients with their lawyers to assess any pending or new lawsuits. Remember one thing, that the most important procedure in this, that I probably haven't mentioned, but it is to an extent obvious because all audit firms perform this, right? You need to get a complete list of lawyers, complete list of legal consultants. And when we talk about substantive procedures related to law, I will tell you that as per the auditing standards, you need to perform 100% substantive testing on the legal general legal ledger. Okay, so the legal expenses need to be vouched 100%, which is test of details basically. You need to perform TODs on the legal expenses 100%. So what you need to do, what you have to do is in test of details is basically you test the details for truth and fairness, correctness and accuracy and everything. Okay, all your assertions basically. Testing of details means what? You have certain details. That means you have a voucher. The date that the voucher was created on, is it related to the current year or not? The amount, is it related to something that needs to be disclosed in the financial statements? If yes, has it been disclosed? Okay. Do you need to make a provision for it? If yes, has the provision been made? Right? So you need to vouch 100% of the legal expenses. Every firm does that, be it a small, medium, or a large firm. Every audit firm does that because legal is something that is very risky. This area is very risky. You get to know, and clients, this happened with me. The example that I was giving you in the very first audit. right? It was not an audit, it was a review engagement, but the client did not give me the complete list and was continuously asking for the the accounts, the signed accounts, okay, the reviewed and signed accounts. And in a review engagement, you guys know that we give limited assurance. Nothing has come to a concern that causes us to believe, okay, that the financial statements are materially misstated. All right. But the point is, I came across it during my review with the partner, right? I came across it when I was reviewing the general ledger, okay, the ledger of legal expenses. And there was an unusual name there that was not mentioned in the list of legal consultants and lawyers, right? And that list needs to be signed, by the way, by the top authorities, CEO, CFO, needs to be signed. If they have a separate money laundering department, anti-money laundering department, it needs to be signed by them as well. Okay. So the point is, I came across a name, right? Against they had incurred some expense, right? And when we asked them, right, they hesitated. So this is also something that is corroboratory evidence. This is also called corroboratory evidence, right? The hesitation of the client. But again, when we, when I inspected the invoice, it was not related to the legal expense. They had parked it incorrectly in the legal ledger, right? It was something related to purchase of an asset. All right. The point is that these things happen. So either it's a reclassification into another ledger, or it's something that they've been hiding. So you come across at least one, you know, piece of evidence. Okay. Now, inspecting correspondence of clients with their lawyers to assess any pending or new lawsuits, obtaining written representations from those charged with governance about complete disclosure to auditors regarding non-compliance, if any. We'll discuss written representations. It's a separate standard, right? Uh, it basically talks about what is written representation, right? The management gives the auditor a document, a written statement saying that everything that we knew regarding this event or regarding this ledger or regarding this, let's say, consultant, we have disclosed it to you and there's nothing else to disclose. That's the final piece of evidence that we get from a client stating that they have disclosed everything. Now, anything that has not been disclosed, the onus of proof lies on the client, provided that we've performed sufficient procedures and we've gathered sufficient appropriate audit evidence with the given population sample. Okay, because there are certain things that they can hide. Okay, they can do it. Let's say they park a legal expense in a very huge ledger, let's say traveling and allowance ledger, and it gets, you know you're lost in that ledger. You cannot find obviously you will, first of all, you will not expect a legal expense to be parked in a traveling and allowance expense ledger, right? But the point is, if you come across it, right, you will not be able to process it, because obviously you will be in awe, right? Why is it happening? How is it happening? This needs to be reclassified, and you need to assess why did they put it over here. Was it an error, or it's something that indicates fraud? All right, they're trying to sway you away from the truth and fairness of the expense account. Okay, if non-compliance is identified, then evaluate the extent to which non-compliance shall affect the financial statements. By inquiring with the directors and client's legal counsel, you're allowed to do that. Okay. Inspect correspondence with the regulatory authority and board minutes for any discussion on the action to be taken. So, for example, let's say in Pakistan, you have for pharmaceutical companies, you have DRAP, Drug and Regulatory Authority of Pakistan, right? And there are certain laws that the pharmaceutical companies, especially the ones who are selling drugs over the counter, they need to abide by the laws, especially those. Obviously, the prescribed drugs are different because obviously, if you you cannot get a prescribed drug over the counter because it's not an over the counter drug, okay. But the over the counter drugs, there's a very limited marketing expense allowed to it. Why do you think that is? As per the regulations, because it's readily available. You don't need a prescription for that. Okay. And prescribed drugs are not marketed using the TV channels. Companies don't do that. Do you think a company will, uh, from business point of view, I'm asking, do you think a company will put up a TV ad or a Facebook ad, a social media ad for a prescribed drug to the consumer? It won't. Prescribed, there's a different marketing stream for prescribed drugs and a different marketing stream for over the counter drugs, OTC drugs. All right. So OTC drugs, obviously, since the consumer base is very large. For example, probably you've heard about Brufen or Panadol, right? These are two major market makers of uh, the fever market, right? Or the pain relief market. These are very good what do you call that? Pain reliefs, right? But the point, and these are marketed. These are marketed to the general public. Why? Because they are OTC drugs. They're not prescribed drugs. Okay, prescribed drugs are, for example, steroids. Those are prescribed drugs. You will not get a TV ad for them. You will never get a TV ad for them. All right. Why? Because obviously a consumer can only buy that through a prescription, and prescription is produced by a doctor. Okay. Reported to management and those charged with governance unless prohibited by law. So there could be certain instances where if you come across, as an auditor, if you come across a non-compliance, right, let's say money laundering, right, you are prohibited by the law to disclose it to the client before you disclose it to the regulatory authorities. Okay. If it seems the non-compliance was deliberate, it should be disclosed to the audit committee, the regulators. If there is an ethical or legal responsibility to disclose it, so anything that is in public interest, you have an ethical responsibility to disclose it. Auditors should consider forming a modified opinion, qualified or adverse, in case the impact on financial statements is material. So, for example, you come across a chemical that is being used in a drug which is OTC, over the counter, readily available to consumers without any prescription, right? You come across a chemical that is very poisonous for the body, it's a slow poison, right? And it's banned, let's say, in the country, but still being used and smuggled in the country. You find a channel, and believe me, pharmaceutical companies are the worst businesses ever, right? They are like, I don't even have words for them, okay? But those are the businesses that I love. I don't know why, okay? But the point is that they're the worst of the worst, okay? They are known to create, uh, you know, illnesses and, viruses and all of that. And then they produce a drug to counter it. Obviously, allows them to make a lot of money, billions, okay? But the point is that when you talk about, uh, you know, something that is in public interest, okay, if there's an OTC drug, over the counter drug, and you find something that is something fishy going on, it's your responsibility to disclose it. Obviously, before disclosing it to general public, you need to confirm it, because if it's not confirmed, if you are not able to produce evidence on it, you will probably go to jail for it, for slander, and for many other things. Okay. So you need to obviously, auditor has a lot of burden, a lot of legal burden on, they're carrying a lot of legal burden, especially the partners who sign the report, who are aware of the entire situation, who need to be aware of the entire situation. If they're not, they're not good partners, and then they shouldn't be on the engagement. Okay. The point is they carry a lot of burden on their shoulders, a lot of legal burden. Okay. Now, responsibility of the auditor related to fraud and error. Okay. What is fraud? Intentional act to deceive, which may lead to fraudulent financial reporting. That is one thing. And misappropriation of assets. That is another thing. So, fraudulent financial reporting and misappropriation of assets. Remember these things. Fraud is related to an intentional act which may lead to fraudulent financial reporting or misappropriation of assets. Okay. What is error? An unintentional misstatement financial statements resulting from incorrect estimates, incorrect application of IFRS, incorrect data accumulation and data processing. You guys get it? Any questions so far before I move on with the procedures?
Yes, sir.
Okay. Now, responsibilities related to fraud, and then you have procedures to perform. Okay. I want you to read the responsibilities because I've clearly mentioned them. What are the responsibilities of the management, which is director and TCWG, and the auditor, right? So I think it's visible. I want you to read them, giving you guys 5 minutes. Let me know if you have any issues in them. What are the procedures that you need to perform? In addition to above procedures, which we discussed earlier, right? Following procedures should be performed in order to respond to the risks. Review unusual transactions to assess indication of fraud. Remember, fraud will have a higher frequency of similar transactions as compared to error. Okay. Review pre-year end and post-year end journal entries to check reversals and double entry. Okay, this happens a lot, which we'll discuss later. Review the basis on which management has formed estimates. How have you created a provision? There has to be a basis for it because it's an estimate, right? Evaluate its reasonableness and assess its consistency with prior year. Obtain written representation from management stating their responsibility for the internal controls. Okay, so make them write it down, make them write down the responsibility and get it, within your working papers, get it within your evidence. Okay, and they have disclosed every instance or the indication of fraud and the process to assess its risk. Okay, report fraud or misappropriation or error to management and those charged with governance, money laundering officer, audit committee. Seek legal advice. You yourself will seek a legal advice, right? An independent legal advice as to whether the auditor should disclose it to third parties such as regulators. If the fraud has material impact on FS, opinion should be modified and explanation for the modification should be given to users of financial statements. Why did you modify the opinion? Obviously, what is modification and how to modify it, why to modify it. We'll discuss that later on in reporting. All right. So these are certain. Now, as for the procedures, I don't emphasize my students to learn the procedures, but to just read them in a way that it makes sense for them. You should know the sense. You should know the tone. The what do you call that? You know, um, I would say it's called the essence, right? The spirit of what you're doing. Okay, it's not something, and not every time you repeat the procedures. Okay, there could be different instances you can perform different procedures, but the validity of the procedures should be there. The procedures should be valid. All right, they should make sense. They should gather sufficient and appropriate. They should help you gather sufficient and appropriate audit evidence. That's why you perform procedures, right? Quality control. There's an there's a standard on quality control, right? ISQC 1, and you have ISO 220 as well. Okay, Firm must ensure that policies, now quality control, remember that it's within the firm itself and on the engagement as well, right? During the engagement, quality control, and within the firm itself. Okay, so firm must ensure that policies and procedures which assist in maintaining professional decorum and in compliance with professional standards are in place, and any issues are reported timely and effectively. Policies and procedures must address leadership, which is what? Who is responsible for setting the tone down the lane? The engagement partners. All right. He should be the one setting down the tone. He should be the one presenting himself for accountability. All right. So leadership is one. Firm must ensure all clients are accepted after thorough client screening and not for fee purposes only. All right. So fee is a very obviously, like I told you guys earlier, that an audit firm is itself a business, right? So fee is an attraction. Higher fee is an attraction, right? But the point is you need to assess your capacity as well. It's very important. It is a responsibility of the engagement partner to ensure the firm such sufficient to ensure the firm has sufficient human resources to cater the engagements. Okay, firm must meet all ethical requirements as per ACC Code of Ethics. All engagements must be appropriately directed, supervised, and reviewed. What should the team members be directed for? How should they be supervised? And what is the timing of the review? Very important. Okay. Team members should be directed for their responsibilities, scope and objective of work performed, nature of business and associated risks, and complete audit plan. If you don't set the direction, the team members won't be able to identify their tasks and their responsibilities. All right. So it's very important for you to set a direction as a partner, all right, or as a senior. Team members should be supervised by more senior audit staff, for example, audit manager, progress of audit work, how much have you done, in what amount of time, have you gathered this required evidence, ongoing assessment of team competence and compliance with ethical requirements. For example, I came across the financials, the draft financials, and I know that any revision will take the profit upwards rather than downwards, and I've bought the shares now. So you need to assess whether everyone is complying with ethical requirements or not. Any significant matters identified during audit and the response. Any external consultation required, for example, evaluation of properties or involvement of experts basically. Adequate time and resources should be allocated to the review of engagement to ensure work has been performed in accordance with the auditing standards. It's not just the work that you're performing. Audit documentation, which we'll study the next, also requires time. So you should be able to assess what amount of time you're left with in order to document what you've gathered. Okay. Sufficient appropriate audit evidence has been gathered. We know what sufficiency is, we know what appropriateness is. We've studied this. Evidence gathered and conclusion reached is plausible. So your evidence and the conclusion that you're reaching, the opinion that you're forming, should make sense. They should corroborate each other rather than contradict. All right. Quality control reviewer, which is also called engagement quality control reviewer, EQCR. Okay. Now, this is quality control review is basically performed by EQCR. Okay. Also known as hot review. Okay. Performed before issuing the audit report. That is, it is part of the engagement. It is part of the engagement. Before you sign off the report, you perform a quality control review. Involves review by engagement partner or a quality control partner, which is also called, like I said, engagement quality control review, or both. Certain objectives are achieved through this review, such as review and discussion on key audit matters. There's a separate stand on key audit matters, which we will study. It's called CAMS, key audit matters itself. Review of significant risks identified. So any significant risks identified, responses to it, very important. Whether the responses catered to the risks or not. Procedures and evidence gathered, and any uncorrected misstatements through inspection of audit working papers. Because uncorrected misstatements might include a misstatement which is probably quantitatively immaterial but qualitatively material. For example, related party transaction. Okay. Review of financial statements and draft audit report. So the wordings, the disclosures of financial statements, what disclosures have been given, the wordings of the audit report are very important. Firm's effectiveness of engagement performance and its hot review is assessed through cold review, whether the engagement altogether performed was on point as per ISAs, as per local laws, as per the requirements of the firm, whether documentation was complete, whether issuing the audit report before the documentation is complete is again not advisable. In fact, it's breach of the auditing standards. Okay, so the point is everything should be complete: the procedures, the evidence gathering, the documentation, and then only you can form an opinion and sign off the audit report. Okay, cold review performed after signing of the report. Performed mostly every year, performed to assess the effectiveness of firm's policies and procedures during engagement, performed by independent partner team. For example, PwC London performs cold QCR of PwC Pakistan, and that is the time when you know the earth bursts open for us. Okay, it's like we feel like it's almost a death. Assessment of working papers and audit documentation is done to assess the quality of audit performed and documented. All working papers must be documented, marked as reviewed, and signed by the engagement partner. Not just marked as reviewed, all right, but signed by the engagement partner as well. That the reason why you need to sign it as an engagement partner is because you need to finish it off. You need to close the working papers. Any deficiencies shall be provided to the firm in the form of a report stating deficiencies and its corrective recommendations. It's more of a beating rather than recommendations. Okay. Now, a very important standard 230, which is on audit documentation. This just lists down all the documents. All right. Auditors must document all activities performed during an audit, that is planning, fieldwork. Fieldwork is when we actually perform the audit, the tasks that we perform, the procedures that we're performing, the test of controls that we're performing. All right. And completion as an evidence of the quality of work performed and compliance to ISAs, it must consist of nature, timing, and extent of audit procedures, results obtained and evidence gathered. What is evidence? It's a piece of paper, right? Could be a piece of paper, could be a scanned copy, could be anything, right? What is evidence that the inventory outstanding was at $1 million at year end? The inventory count sheet. You get a copy of that. That is your evidence. Okay. Significant matters, which is key audit matters identified during the audit. I've given you guys examples over here. Planning documents include walkthrough of clients. Walkthrough means, what does a walkthrough mean? It is performed for the understanding of the client. How and what is being done. What department is responsible for what. Okay. Overall audit strategy, risk assessment documents, deadlines, timelines, people coming in, people going out. That means your team members, right? So there's a change in team member. If, let's say, a team member is rotated from the engagement during the engagement, all things need to be documented. Okay. Performance documents and completion documents. Obviously, these are certain things that you just need to remember, not to an extent where you probably, I'm not asking you to list down each and everything, right? But the point is you should know what documents are created. And obviously, when we look at the procedures, and the evidence topic, right? We will look into it in more detail. Okay,
Yes, sir.
you guys get it? But obviously, before the next class, which is on Monday, I want you to revise these two classes, right? This one and the previous one, so that we can do the
Okay.
questions easily. Advantages of documentation. Obviously, it assists in planning. Something you have discussed with your audit manager, not documented it, you tend to forget it, right? Assists in tiny reporting of work performed. So the documentation should be available to everyone, all right, even the partner, at the same time as to the junior. Okay. Assists in directing, supervising, and reviewing tasks performed. Assists in QCR and acts as an evidence of findings for audit to be performed next year. Okay. Secure your working papers. It is your responsibility. Your working papers, that is the basically the work that you've performed as an auditor, it's your responsibility to protect them. Okay. It's a responsibility of the auditor to retain the working papers in some jurisdictions for at least 5 years and secure them. Laptops must be protected from theft, and physical papers, if paper-based audit, must be protected from being reproduced. Counterfeiting, obviously. Reproducing evidence lost is expensive. Okay, so these are just basic points for you to remember, that working papers are your responsibility. They're not of the client. They're not a client's responsibility, not director's, partner's responsibility, your responsibility. Whoever owns the working paper, whoever creates the working paper, it's under your ownership. Obviously, technically, it's not in your private ownership, it's in firm's ownership, right? It's not like you, if for example, you are not there in the next audit engagement, no one will be able to review your working paper. It's not like that. It's firm's property. Okay, you get it?
Yes, sir.
Yes, sir.
Okay, so that is it. Anything that you don't get in this topic?
No, sir. It's pretty clear.
Sure.
Yes, sir.
Yes, sir.